What's up guys, it's Carlo here, and in today's video I'm going to be going over my thoughts and opinions of what's going on in today's real estate market here in sunny Southern California and where is it going to be heading to in the near future. I will first say that the current market is bananas. Today there are so many properties that are selling so fast within a matter of days, way above market value. So property values are climbing higher month to month and interest rates are at an all-time low. But however, there's a very little inventory. So with the things of supply and demand here in Southern California, prices are getting so high. So what should you do if you're a first-time home buyer or looking to get into the market? But before we start, make sure you hit that like on this video. It will definitely help me out with the YouTube algorithm and it would make me very happy. So diving right into it, we need to look at historical data to see when and where how we came from to now. Back in 2008, in the housing market crash due to the widespread defaults in subprime mortgages, many borrowers were given loans, also known as ninja loans, where you don't need any income, no job, and no assets to qualify for a loan. So these mortgages were often issued with no down payment, no proof of income, and no documentation whatsoever needed by the lenders. This drove many people to go and apply for homes in real estate because obviously you can make a whole bunch of money in real estate, right? Which definitely drove up the prices. Many borrowers soon found out that they couldn't pay for the mortgage loan and soon were underwater in a declining housing market where their home values were lower than the mortgages that they actually owed. Soon the variable rates, also known as teaser rates, started at very low interest rates and ballooned over time. So what does that basically mean? As the interest rates are a lot lower, you pay less and less money, but as a balloon over time, think of a balloon, it gets bigger and bigger, and soon they're not able to manage this increase in payment, making it harder for them to pay off the principal on the mortgage. In response to the Federal Reserve, they started bailing out banks and lowering their interest rates in an effort to boost the economy, as we see today in today's current market, and it eventually worked. So from 2011 to 2019, the real estate market has made a major comeback. Now, fast forwarding today, the COVID-19 has shut down the economy and affected the stock market, which dropped from 40% from its all-time highs. So most of us would think that home prices would drop how they did back in 2008 to 2013. However, the opposite has happened. The federal government has stepped in and they provided the 2 trillion CARES Act, the HEROES Act, the stimulus package for the $1,200, the unemployment benefits, the additional $600, and in addition they froze rent, the forbearance for rent as well as mortgages, and also the federal funds decreased their interest rate down to 0% to help stimulate the economy. So what does that mean for us who are trying to get a mortgage? It means that it is the cheapest time in history for us to be able to buy a home. So mortgage rates have been a record low after a record low during this pandemic. And here's how it works. When you put a down payment on a home, the bank loans you money at a specific interest rate for a specific term, whether it be 15 or 30 years. The lower the interest payment, the more you could afford a home and less that you have to pay. But the higher the interest rate, the more you have to pay and the less of a home you could afford. So say for example, you buy a $500,000 home at 4.25% over here, and say you buy a $500,000 home at 2.9% that I'll show over here. You'll see the difference in principal, interest, taxes, and insurance, the PITI, over time. But due to the pandemic, many sellers don't want random people walking through their homes, potentially touching everything and getting themselves as well as their home infected with the coronavirus. But looking everything from a macro perspective, massive job losses, major uncertainty, this creates panic and fear for most homeowners. Therefore, they're afraid to list their homes, creating a major shortage of supply of homes in the market. This shortage of supply of homes in the market in turn creates a surge in price. So thinking of it in the law of supply and demand, low supply, high demand. On segueing into that, in addition, the historic low interest rates for mortgages creates a lot of demand in the marketplace for people to want to buy homes because it's the cheapest it's ever been, and it's getting more and more competitive to purchase a home, and where we're seeing multiple offers on a home, which basically creates a scenario where home prices are bidded higher, higher, and higher. Choose to invest in real estate to diversify their investments, and in relation to the volatility of the stock market, real estate is a lot more stable. As you could see in the most recent months, in regards to the stock market, the price fluctuation is going like this. However, in relation to the real estate prices, year over year, it's pretty much been consistent. And when looking at it from an opportunity cost in real estate, it can be a great hedge to inflation, with home prices going up around 3% year over year and inflation staying around close to 2%. Things to watch out for is the CARES Act and the mortgage and rent forbearance. So basically, what does this mean? There's not really going to be a mass of evictions for renters as well as people who own money on their mortgages. So it's definitely has been pushed back to the end of 2020 and early 2021. So with no evictions in relation to COVID-19, we're not going to see massive foreclosures within the rest of the year of 2020. So to keep a watch out on our economy when it reopens and the return of jobs to the labor market, this will give us a better indication of which sellers really need to sell and the true demand for real estate within the market. And if the economy does open back up and consumer spending is at an all-time low, with interest rates remaining at an all-time low, the demand for real estate is going to continue to still be high. But on the flip side, if things get better within the next 6 to 12 months, interest rates will slowly go back up, with more sellers coming back to the market, and potentially housing prices will fall. But there's no guarantee. Some key economic indicators to pay attention to is the interest rates, consumer spending, unemployment benefits, stock market, and jobs coming back to the economy. But if you are in the Southern California market and looking to buy or sell a property, feel free to contact me. I'll leave my contact information down below, and I'd love to help you out to help you achieve your goals. But with that being said, thank you so much for watching this video and smashing the like button and hitting the subscribe button down below. Feel free to follow me on Instagram, LinkedIn, and if you would like to find out more on how to become a real estate agent, I'll leave a link in the description down below. Hope you guys enjoyed this video, and I'll see you guys on the next one. Peace.